Well, hello and good morning. It is here. I want to show my screen because I'm very excited about this title here. Okay, the American Rescue Plan Act, the webinar. Now, you may have seen the movie, you may have read the book. No, none of that exists. It just happened back on March 11th, so the ink is still drying on this yet another change to the code. And this one is my favorite thing to say now. We kind of talked about it a little bit in our last webinar. That never have they actually made changes that impacted the current filing year, and this is it. So yeah, we really wanted to make a big deal of of the ARPA, which I've been calling it affectionately, the webinar. So with me, so I'll stop sharing my screen real quick. And get it back over so you can see these lovely faces. So you know me, I'm Conrad. Conrad Basom, and with us here, I guess I'll point up, but I think we're all in different panels depending. So above me, I have the lovely Kathy White. I have diagonal maybe over there. I don't even know which one's right or left. Well, I was pointing to Chris. Sorry, Tara, but it should be ladies first. The equally lovely Tara, Niha, and as well as I keep doing that.
Tax dude.
Tax dude. Oh, that's right. Yeah, tax dude or tax queen or tax wizard or Tara. You know, we're all having a good time with it. But real quick, let's get back over to the reason why we're here today, of course, and that is the ARPA. So with it, a little housekeeping for us. Let's see if this will work. There we go. You can't see us, but we can see you. So if you raise your hand, we won't be able to call on you. So if you do have a question, please throw it in that chat box. We're going to do our best to be monitoring that at the same time. I'm not fancy enough to have an assistant over here checking, so it will be me. So I'll probably be doing that when I'm not talking. So I'll do my best to look at that and phrase the question. Everyone registered will get the slides and the recorded webinar, so that's just a good piece of information for you. And if you want to share it with your friends, you're welcome to. And as I mentioned earlier, the ink is still drying on this thing, and more changes are on the way. So some things we're going to bring up now is what we believe, which is terrifying, opposed to what we know for certain. So if something's, if you're confused about any of this, and there's a good chance that you will be, go ahead and email your CSM directly. Would love to take a phone call right now, but we're a little busy. So email really is the best way to get a hold of us. And then also, I just want to chime on this again, newsletter. We send at least one a week, and I know it seems tedious, and I know there's a lot of information getting thrown around right now, but this is really the best way that we can connect with you and let you know that things are changing, and things are changing constantly. So much time and so little to do. Scratch that, reverse it. Okay, so here's basically what we're going to be covering today. I wanted to put enough bullet points up here to confuse and bewilder, and I think I did. We're going to try to cover all of these topics. We have our payroll specialist here, Tara from Serendipity, to help out with some of the payroll questions, but we're going to cover a lot of things. And to start it off, I'm going to have Kathy take it away. So here we go. Boom.
All righty. It doesn't tell me which screen you're looking at, so.
We're seeing your desktop PowerPoint before it's set up in the presentation.
All right, so I need to switch my view, or.
And you start the.
Whoops, maybe not. Sorry.
No.
You do a lot of QuickBooks stuff, don't you?
How do I change to screen monitor 1? How's that? Now
yes.
There we go. Yeah.
We're seeing the
Yeah.
I don't think we want to be seeing the There we
go.
There
how about this one? How about April 15th deadline has been extended?
That'll work.
Thank you for your patience with that. So anyway, with the Congress is done, IRS is done. We have extended the April 15th deadline to May 17th, and that is for 1040 filers and Schedule C filers only. If you have a business, a corporation, a lot of the S corporations and partnerships, that was the March 15th deadline. The April 15th deadline still remains in effect for our C corporations. And also, the other thing that remains on April 15th deadline is our estimated tax payments. So the estimates for 2021 are still due on April 15th, but the May 17th extension on the 1040s means that if you do have a balance due at the end of the year, you have until May 17th to make that payment. The other thing that has been extended, which is really quite sweet, is if you wanted to make an IRA contribution or if you wanted to fully fund your health savings account, both great ways to save on your taxes. We have until May 17th to go ahead and make those contributions. So that is nice. If you live in Texas, Louisiana, or Oklahoma, the IRS has graciously given you until June 15th due to all of the weather concerns that have been going on there. So a couple of things that have been approved that is retroactive. One of them is the repayment of the premium tax credit. So if you are one of the ones who went on one of the state exchanges, the California, Covered California, the marketplace, and you have health insurance coverage through them, and you received some sort of a subsidy on your health insurance premiums, and for whatever reason, your income has gone up in 2020, so there has been a calculated repayment that means that is due. For the tax year of 2020, that has been repealed, which means you don't have to pay it. So that's really good news. So what happens with the premium tax credit, it's all based on your income and it compares to the federal poverty level. And what is that amount? It depends on the size of your family. But what was happening was, is once you hit the 400% level of federal poverty, you actually had to pay all of that premium back. So it didn't matter how much the premium was that you received, that credit was being repaid back. I have a client that owes about $7,200 worth of premium repayment. So they're very happy about this premium being repealed. If you have already filed your tax return for 2020 and there was a calculation for the premium tax credit to be repaid, the IRS is requesting that we not amend those returns at this time, that apparently they are going to be doing the calculating and refunding the taxpayer. So we'll keep an eye on that. We'll see what happens, monitor your bank accounts, see what's going to happen, and we'll, I think the IRS is just overwhelmed right now, and so they don't want more tax returns being filed, and we'll kind of wait and see how all of that works. Interesting, the premium tax credit has also been affected for this calendar year, 2021 and 2022. So there are some changes being made there. They are actually increasing the subsidy amount. And I actually have a chart with some numbers, and they're being very generous with this. Then 21 and 22, they are repealing that 400%. They call it the cliff. When you hit that 400% of federal poverty level, you had to repay everything, and that has been adjusted now. And now there is, they also extended, you have, I think it's just the month of January, where you can go in and apply for the health insurance through the exchanges, and that deadline has been extended through May 15th. So you can pop back up there and get that.
Kathy,
yes,
question for you.
Yeah.
So, and I'm just, you know me, I'm always looking for the angle here. So if I'm on a Covered California policy and I have my income posted at 30,000 for the year, and that gives me a certain amount of whatever, right?
Subsidy.
Premium assistance, right?
Yes.
If I went in and said my income was 20,000, I got more assistance and therefore paid less for my insurance, then next year when I filed my return, as long as I'm still below the 400%, I'm not going to pay back any of that money.
No, that is not what they've done for 21 and
Okay.
22.
Okay.
What they're doing is they're adjusting the subsidy amount. So what does that mean? So right now, I don't know if you can you see these numbers?
Oh, absolutely.
So
Yeah.
for 2021, and then in 2022, the numbers are going to adjust a little bit. So let's say you're 150% above the federal poverty level, and you are 21 years old. Without this change, your premium tax credit would have been $4,300. You would have paid $800, and you would have had the credit of $4,300 towards the health insurance amount. And that's current statute. But now, under the new ARPA per Conrad, if you're 21 years old, the premium tax credit would still be $4,300, but now you pay nothing. So that's a big difference between paying $800 a month to paying $0 a month. And what I'm really enjoying is this: if you're 776% above the poverty level, with the new program, with the new ARPA, if you were 64 years old, the maximum you're going to be paying is $8,500. So even though the credit is $12,900 and your income goes up substantially, you're still limited to only the $8,500 that you would have to pay. You don't have to pay the additional amount. So it's really quite a savings. How that all adjusts, and if you could go in and say, hey, I'm making less money, getting more of a credit, we're still waiting on a lot of guidance on this. So we'll have to wait and see how some of this guidance comes out for us. So the other thing that has adjusted is the paid sick and family leave credit. These benefits were set to expire on March 31st, which is today. They have been extended through the end of September. So what does that mean? That means if you have COVID-related sickness, you get to have 10 days of paid sick leave. If you need to stay home for any family member, this includes even if you're staying home for the vaccination or schedule the vaccination, any side effects of the vaccination, any family members that are sick. So you will be compensated for that. The employers, however, are not required to provide any additional paid sick and family leave benefits, but if they do, they can claim 100% of those benefits. And in the state of California, the employers are mandated for 3 days. I think Tara will probably tell us a little bit more about how this all works on their payroll. But we do have another 10 days of paid sick leave that starts on April 1st that we are eligible for through through September 30th. Now, the paid family leave, there is no reset, but it has been increased from $10,000 to $12,000. And somehow, the self-employed taxpayers can claim 60 days of paid family leave, and it used to be just 50. So that has also increased and is more generous. Everybody's very excited. The Paycheck Protection Plan loans that have all been forgiven. There's another round. I hear from a number of my clients, the banks have already been reaching out saying, hey, you want some more money? To qualify, there are some qualifications to receive the second round of PPP money, but there is $7.25 billion in funding that is available for employers. And it was March 31st was our due date to get that application submitted, but that has been extended by 2 more months. So you have until May 31st to go in there and get some more money. And if you're a nonprofit, they are also extending even more money to the nonprofits. So all of that has been extended. So take advantage of all of that. That is the end of mine. I'm going to toss this back to Conrad.
All right. Okay. And I should have just taken it because what the box that was just up went away. Here we go. So I want to get my PowerPoint set up again. Oh, it knocked me completely out. That's perfect. Okay. Bear with me. We'll do this, then
Can
we'll do this.
can you grab it? Because I think it's asking me if I want to be presenter.
Oh,
There we go. Show my screen. Perfect.
Perfect.
Okay. So we're seeing this now. Beautiful.
Yep.
Okay, so third round of economic impact payments. So yes, this is the third one. We were joking at the beginning of this. We don't know how many it'll end up being, but we definitely know it's going to be more than the first one. So to kind of do a quick recap, and if you want better explanation of the previous stimulus packages or stimulus payments, just look at our last webinar. This one's more specific about, we now actually have the specifics of what Chris was talking about, all hypothetically before, because it still hadn't been signed and been put into place. So this third round is much like the CARES Act EIP and the Consolidated Appropriation Act in 2021, but it's a little different in a couple ways. The biggest difference here is it's an increase. It's up to now $1,400 per taxpayer, and dependent. So before, the kids, or you didn't get anything for older kids. Now you get it for adults as well. So this could be a high school, a senior. This could be a young college student. We've had this conversation, I don't know how many times, with our clients already, of, okay, well, maybe this is the play this year. Do we want to claim them? Do we want them to claim themselves? Well, as far as this is concerned, because everything depends. I can't give you a blanket answer for this, but in this case, adult dependents qualify. That could even be mom or dad that's moved back in with you, and that's $1,400 a pop. So for me, for my little family of 4, I'm looking at $5,600. Now I haven't seen it yet, so I'm hopeful that it's still coming, but I know that people have started to receive this already. And the AGI phase outs are much smaller. We're about to cover those in a second. You'll see that on the next slide. And it's based on your 2020 adjusted gross income if it's been filed. If not, then they're going off of 2019, and then we'll reconcile it later, because these advanced credits are going to be going against 2021, not 2020. So another thing that you've probably talked with us about in our meetings, if you've had your client appointment or your completion appointment, we've been asking about, well, what did you receive for 1 and 2? The way it's being documented in the tax return is it comes through as a recovery rebate credit, meaning if you didn't get the money and you should have, or you didn't get the money because the return that they went off of, you had too much money, and then you filed your 2019, or you're filing your 2020, they add it back in the form of a credit. So it's as if you had additional payments or additional withholding. So it's going to be treated similar again. This money that's just coming out now, we don't need it for your 2020 return, but we will need it for 2021. So that's kind of little things about this. Oh, and with it, the first 2 stimulus also were protected from garnishment. This one, because of the speed and at which it got pushed through, didn't have that written in, but we assume that soon that will be fixed, just like the past ones, to make sure that the money actually does make it to your bank account. Okay, and here are phase outs. So similar to the previous stimulus, this was kind of the threshold. It was 150,000 for a married filing joint, 112 and 5 for head of household, and 75,000 for single or married filing separate. The difference with this is that these thresholds are much smaller. Before, you used to be able to get up to, for married filing joint, you didn't lose all of it, depending on how many dependents, depending on other things. You could make up to $198,000 and maybe still get a couple pennies of it. With this now, it's a very small window. If you're under 150,000, and we're just going to keep it simple with married filing joint, you're going to get it. You qualify for it. If you're at 165,000, you get none of it because now we're past it. When before the previous stimulus payments, you would have gotten a little bit of it. So it's a little tricky in how that's happening, but that offers, or it opens up the opportunity for a lot of different planning and things that we can kind of do to help that. Because how are the payments determined? Well, the initial payment is based on your 2019 for most. Like we just said, it's either your 2019 if you haven't filed 2020 yet, or they're going off of your 2020. But after all the returns are filed, additional payments may be sent. So IRS is under the impression, or the IRS is under the impression that they don't have enough going on already, and that sometime in July, they're going to be able to also catch up, review everything that they've already filed, because they're not still working on 2019 returns. Oh wait, they are. This is yet another way of, and I commend their effort, because they're trying to help people. They're trying to get the money out there, and they're saying, so if after all of this crazy season is over, you didn't get the money, and you should have, because now you filed your 2020 and that income is down, it's actually worse than your 2019 return, very common theme this year, then they're going to attempt to send out another batch of this later on. So with that, it's all based on your adjusted gross income. So reduce it. There are some things that we can still do for your 2020 return. Of course, it would also require that you haven't filed yet. So if you've already filed 2020, we probably don't want to amend it, because we've been told multiple times by the IRS, please don't amend anything. Don't send us any more than you've already sent us. We'll figure it out eventually. So for the 2020, you can do things like IRA contribute to an IRA, maximize some depreciation, look for any above the line adjustment that you can do. A new one this last year was cash donations to a charity. So that's not going to get us that low, because that's limited by $300, but other planning things here could help you go from, if you're on the bubble, say your income is 165 and you're over the 160 threshold, and you file that return, they're going to say, yeah, no extra money for you. But if we're strategic in what we do this next year, in 2021, since we're going to reconcile, like we said, we're going to figure this all out next year when we're filing this year, there's a chance that, although some of these things, I'm kind of talking in circles, some of these things you can do now to still impact your 2020 return. The way to fix it, if we can't do anything about that, is now in 2021, hopefully you're still employed, hopefully things are going well for you, and if you haven't max funded your 401k in the past, here's a great opportunity to do so, because that's going to lower our adjusted gross income. We use that money throughout the year to benefit from it, and now we get a little bit of stimulus cash too. But that's way too into the details for this webinar, because we're covering so many different things. So we're going to keep moving, but keep in mind that just because a lot of people are hearing this and going, well, my income's over 150 and I'm going to tune out. Not necessarily. We still want to be paying attention. There could still be money that's available for you, but you got to be able to play the game. Okay. And then I'm going to take a break before I jump into the child tax credit. So now it's time to hear from Tara about some payroll. So I should be able to do this. Where are my presenters? Everything went away. My goodness, I am struggling today. Why is it? Okay, if I stop, there we go. It's on that same screen. So here we go, Tara. You take it away, please.
All right. Can you guys see the screen that says employee retention credit?
Yes.
Under the Okay, so first I want to start by just giving you a quick walkthrough of where we were and where we're at, because what happened in the past, you can still take advantage of some of those credits. So back in March 27th of 2020, it's been just over a year ago, the CARES Act put in the employee retention credit. This was kind of really quiet. It was a whisper because the PPP had just come out and everyone was talking about the PPP. Chris, though, was a very smart man, and he knew. He said, this is something good. People should pay attention to this. So it was something we did a webinar on last year, and what was going on at that time is the employers that did not take the PPP loan were able to take a 50% refundable tax credit for each employee up to 10% of their wages. Essentially, it's a $5,000 tax credit per employee for the rest of 2020. So let's fast forward and whoops. So after the CARES Act put that in place, that was changed again, or I should say updated somewhat through the Consolidated Appropriations Act, which went into effect on 12/27. And what this did, it actually took away that piece of the that disqualified a lot of business owners. It said that if you took the PPP loan, you can still be eligible for that $5,000 credit or up to the $10,000 of wages per employee. So then that really started opening some eyes, because now here's the year ending, W-2s and tax returns are about to be filed, but wait, some people now can take, some employers can take that tax credit. So when this Consolidated Appropriations Act came out at the end of the year, a lot of words started getting stirred, but your payroll company that was doing your tax returns, they still had to file everything on time. So those all were filed, but now they're allowing you to go back, and if you qualified for that, you can amend your tax returns from last year to take into effect that $5,000 per, or up to $5,000 per employee. So to just recap a little bit, you could have taken it last year. Most people didn't. I think we had less than a handful of clients that took advantage of it, because most people got the PPP. Now, if you got the PPP, it's time for you to look to see if you qualified for it last year, because if you did, you can go back and get that credit. One of the things that changed, so with the Consolidated Appropriations Act, there's a couple of different changes besides the removal of the PPP restriction. They also extended it through June 30th of 2021. So now that means not only can you look back at last year, let's look at Q1 and Q2 of this year and see if you qualify for it. They also increased the qualified wages. Instead of it being 50% of the 10,000 in wages, it changed to 70%. So now you're looking at $7,000 per quarter, which before it was $5,000 credit, up to a $5,000 credit for the rest of 2020. So it's increased in percent, and it increased that it's not for the rest of the year, it's per quarter. So that's a huge deal. Another one of the things that changed was what makes you eligible. So we're going to go on the next screen, we're going to talk about eligibility, but just one of those changes was one of the tests required you to have a decline in gross receipts by 50%. And that now has changed to greater than 20%. So a lot more businesses are eligible that were not eligible before. The cap is still 10K, but you get more credit because it's 70% of that versus 50%. Whoops, wrong way. Okay, so I think I kind of just said this, but the American Rescue Plan was passed March 11th, and like Conrad said, the ink's still wet. I mean, we're jumping all over this to educate you, but there's still, just as the other plans acts that came through, we learned a lot through the way. So everything I say today is based on what we know as of today. So they have extended the employee retention. So when I use ERC, that's employee retention credit. So they've extended it now to go all the way till the end of this year. So before it was till the end of 2020, then to the end of June. Now it's extended to the end of this year. So essentially this year, if you qualify, you should definitely look to see if you qualify, because that's up to a $28,000 credit for this year alone for each employee. So it is huge. And if you get to take credit from the $5,000 credit last year, that puts you at $33,000 per employee. So that's up to that amount. So remembering that, you know, it's 50% of the, or I should say now 70% of the wages up to $10,000 in wages. Some things to keep in mind, you can't double dip. So for example, if you did get the second PPP right now, or even when you had the first PPP, you can't use the money you used for the PPP forgiveness also to get this credit. So if you paid your employees in all of, you know, February and March, you used up all your PPP money, maybe during quarter one, you're not going to have that much of credit, but now in quarter two, your PPP money is spent, and now you, if you're qualifying for this, you'll get up to a $7,000 credit per employee. So I'm just making sure I'm making, you know, getting the impact there, because I think that a lot of people, there's too much coming at everyone, and no one really knows what to, there's so many things, like what should I pay attention to? This is one you should pay attention to. So let's talk about the eligibility. So there's 3 tests, and then so the first 2 tests were part of last year as well. So when they came out with the original act, these were the first 2 tests. You had to meet one of the 2 tests. These are the first 2 I list. Gross receipts. And essentially what they're doing there is they're having you look at your gross receipts to a comparable quarter from 2019. So for example, if I'm looking at my gross receipts from quarter 4 of 2020, and I want to know if I'm eligible, I can compare that to my gross receipts of quarter 4 of 2019 and see, did I have that drop in decline in gross receipts? So that's one test. Or, and remember I'm saying or, because this affects majority of businesses in California, your operations were fully or partially suspended in order to apply the government order related to COVID. So back last year when the government shut everybody down, unless you were an essential business, you would have fallen into this. So and into this operations one. So those are the 2 tests that were originally brought out. So those are the 2 tests that you're going to be utilizing to determine if you're eligible. Now with the new act, ARPA, they added on something new for startup businesses. This is huge, because before, if there's so many businesses that people that lost their jobs, they decided to go start a business and use this time to do something that they may have not had the courage to do before until they were forced into it. So now, if you are one of those startup businesses and you began operating after February the 15th, and your gross receipts do not exceed $1 million, then you're eligible for up to $50K in quarter 3 and quarter 4 of this year. So that's up to $50K credit for the employee retention credit between those 2 quarters. There's no requirement to meet one of the other 2 tests. If you're a new business, look at this and see if it applies to you. Now, one thing I want to talk about, I don't know if it's on my next screen or not, because we get this question a lot. It's the, you know, you are a new business, you opened up your doors, it's just you and your wife working, or you and, you know, your brother. Relatives are not qualified for the employee retention credit. So, you know, if you have other employees, if you're a new business and you have other employees, or even talking about all the tests, you know, no one's, you can't use people that the IRS list here as, you can't use the wages for them as to get the credit. Other people, that's the people you get to use for your wages for your credit. Now, I will say this was not out when this information was not brought to our attention when the first act came out. It was not brought to our attention when the second one came out. Literally, this is we are just getting this information now, but my guess is it's going to, you know, if this is the case, you won't get the credit you should not take the credit for the previous year. If you already did and this information wasn't provided to us at that time, then that's, you know, just what it is right now. But just like here, I put spouse. because spouse is not listed here. And like I brought it up to Chris, he said, I'm sure it's an oversight on the IRS part, but so we have a lot of clients asking us about spouse, and I'm not the law, so I feel like it's an oversight as well. So that's just something to take into consideration. Then there's also this is another person that's considered a relative. If employer is a corporation, then a related individual is any person, and this is quoted from the IRS, that bears a relationship as shown with individual owning directly or indirectly owning 50% of the capital and profits. So just to think about that if you have partners in your corporation and their family members. Next, I did take this from a law firm that had posted this online. I love it. I'm not going to read it to you, but if you get these slides, save this sheet because it's going to tell you each of the acts that took place, what were the qualified wages, the amounts, and then it's going to just kind of detail everything, the eligibility test. So this is just a really nice slide to sum up what I've already said, but I just like how they put it all together in one spot, one spreadsheet, because it is confusing. Uh-oh, it looks like I have a missing sheet there. What was I going to tell you next that I forgot that I did not save? I think I was going to say that one thing to know also, the IRS has extended the audit period for 5 years instead of the normal 3 years for these COVID related things. So I'm sure they're wanting to, what's the word?
Scare.
They're wanting to scare people to not, don't jump into things fraudulently because it gets ugly later. But if these apply to you and these work for you, sit down with your CSM and find out, do you qualify? And if you qualify, reach out to your payroll provider, let them know which quarters you qualify for, and then they will do the amendments for you. It is a payroll amendment to the 941, so you will have several amendments. There will be charges for it. There are some firms that are doing it for people, so they're not taking it to their payroll company. They're charging around 15% of whatever your credit is. Ooh. We have a client that's doing that through a firm, and I was like, well, we can amend those for you, but they said, well, we don't even want to get you the information, so they're happy to get 85% of the free money. But so there are firms out there that are doing everything for people, and they're taking about 15% of the credit. Or reach out to your payroll provider and they'll do it for an amendment charge, which will be probably about $500 a quarter, which would be much less than 15% of your credit. So, but be patient. It will take time. Like Conrad and Chris had mentioned, the IRS is extremely backed up. They're very slow. Amendments are taking over a year to be done for the IRS to give the money back. So it's not a quick fix, but you will eventually get the money back. Yep. And that's it. If anyone has any questions, I'm happy to answer.
Thank you, Tara.
Good information.
You're welcome.
Yeah.
And taking it back. Okay. Let's see. Am I sharing my screen?
Yep. We got
Perfect.
20 minutes to cram all this in.
Oh,
so
Tara's gone. Okay.
Oh.
Uh-oh.
She gone. Okay. Oh no, I think I heard her. Maybe she turned off her video. Okay. Oh. There you go. Yeah, I heard the kids screaming for half a second, and then you might have seen me go to my phone because Allison's like, we're going to my mom's. So I said, okay, thanks. So yeah, hey, Tara's back. Okay. Yeah, so like Chris said, we got 20 minutes. We'll get through as much as we can. And sorry, I meant to do a little more preface in the beginning. Sorry for the jumble here because we are jumping all over the place. There's just too much to cover in what's going down on the ARPA, and I feel like that's trending with how much we're saying it now. So it's pretty fun. But one of them here, since I got kids, I figured I would cover the child tax credit. This is yet another thing where I think the IRS is trying to do too much. We'll get into that in a second, but basically, it's been kids have been getting more valuable as the years have been going on. You know, you get now. This last year, I was stoked to get $2,000 a pop. Now it's jumping up to 3,000, and since my kids are under 6, 3,600. Show me the money.
Oh,
Yeah, no, I'm very excited. I'm very excited about this, but of course, because it's specific to the pandemic, specific to everything going on, they're saying it's just for 2021. Sure, because things are getting so much better. Um, I'm too pessimistic. I love Tara's yeah, she was happy and excited. It's new businesses. Get out there and get some money. Yeah, so with the kid credit, it has increased. I wouldn't be surprised if we find out next year that it's only for 2022 as well, and then maybe just forever. And that that'll encourage us to keep having children, and it'll be great for everybody. So yeah, with how it is right now, they've boosted it up. If you got really little ones, you got even more money. My favorite joke to tell here is always, but they cost a lot more than that. So don't just go have a kid to get a credit. That's I shouldn't have to say that. Um, so the next new thing with it is that it's fully refundable. So in the past, it was what 14, only 1,400 of it was actually refundable. So if you didn't have taxes to write off, if your tax liability was zero, and you had this credit at the bottom, you didn't get the full two, you only got 1,400. Now the case is you get all of it. It's fully refundable, and there's no earned income requirements. So the other part of it was you had to make a little bit of money to be able to claim it. That's been taken out too. So we're going to have a lot of interesting returns filed that have no money, that have dependents showing
income,
up that have
right.
never, no income, that have dependents that haven't been claimed on returns for years. So there's going to be a lot of extra work, and that's kind of where I was saying the IRS is kind of biting off more than they could chew. Because then here, this is where it gets really interesting. They're allowing for advanced payments. We're going to expand on that in just a little bit. And they're pulling back on their, once they're 17, they're not a kid credit anymore, and now it's an other dependent credit, which is only 500. Now they're saying as long as the child was not 18 by the end of 2021, they can still qualify for the 2,000 or the 3,000. So huge improvement there, when before it was always okay. It was kind of felt like Disneyland. You're 17, it's over. No more kid credit. Go get a job. So here we go. So the phase outs increased too, depending on how much money you made. You didn't get any of the kid credit anyways. But the additional $1,000 is phased out at the lower income amounts. The original 2,000 is phased out at the higher income amounts. So to give you, it would be nice to have a slide that I tell you what those are, but I don't. So I can probably update that before we upload the slides, so you'll have more information there.
Cool.
But it's basically to the point of the $1,000 phase out is right at their threshold. They're loving for married filing joint at about $150,000. The 2,000 was pushed out previously to go all the way up to 400,000. So high income earners, although you could have young children, you're probably not going to get the extra $1,000 on top, but you should still be able to get the 2,000. Just depends on your income. If you're making $500,000, stop talking, or stop listening. This isn't going to work out for you. But yeah, that's basically the phase out has increased. The advanced payments is what I want to take a little bit of time on. So they must come up with a plan, which I love when we see stuff like that. We were on a webinar not too long ago with the IRS, and they kept saying you're going to have to hold on that. We'll have better information for you soon. So they're hoping that by July 1st of 2021, they will have survived the season and now be able to direct deposit monthly the credit ahead of time. So I don't feel like I'm explaining that properly, but it basically means instead of when you file your tax return, you get the credit, They're trying to set it up so that throughout the year, you're going to be paid that credit that you're owed throughout. So you need your money now, you get your money now. Multiple issues with that is the fact that then we're going to try to reconcile for this later. We're going to try to catch up on this later. We could find out that, oh, my income increased and now I didn't actually qualify for some of that credit and I got to pay some of it back. There's a lot of issues with a forward payment like this, but I'm sure we will work it out. Right now, we're kind of recommending people just opt out. They haven't set it up yet, but they're going to set up an online portal where you can opt in and opt out. So that's how they're going to try to regulate all this. But as we know, the IRS websites aren't their forte. Technology isn't their forte. So the idea that it won't be yet another broken website. I got to stop rambling. We don't have time. So yeah, law says they will be direct deposited, but for taxpayers that don't have direct deposit information, good luck doing that. So they're going to mail you a check, maybe. We'll get more guidance on this later, most likely. And there's your reconciliation. I didn't even mention that. So divorced parents that swap the kid back and forth every year, that's going to be confusing. Like I said, their income going up and you shouldn't have qualified for the credit. Now they're going to have to pull some of it back. It's going to be a mess. So best, easiest way would just be, why don't you just wait till you file and get it then? That would be the best way to do it, because I wouldn't be surprised if a lot of taxpayers, and none of our clients, of course, but I'm sure there's going to be plenty of taxpayers out there that are going to say, oh, I never got that monthly. What are you talking about? I want the credit I got to get all year, as well as the the credit on my tax return. They'll figure that out. To Tara's point, they're extending the statute of limitations on all of this stuff, because they know that when people see an opportunity, they jump at it, and with it, they're overwhelmed. They're working too hard. I feel bad every time I call them, and they only pick up a quarter of my calls. So there's issues over there. But yeah, with it, try to pump the brakes on as much of this as you can, and be thankful you have shelter and food. Along with this, we also have the Child Independent Care Credit. So this one, again, the joke is always they cost more than you'll ever get in return for it. But they decided to not only extend the kid credit up to the 3,000 or 3,600, but they've also increased the amount of credit we can get for dependent care. Now, this has its own thresholds as well, and I'm kind of confused as to why they would do this in a year that there was no dependent care. I mean, essentially, daycare shut down, all sorts of places shut down, and your kids weren't away, your kids were stuck in the house with you. So the idea that you would actually have dependent care in this year, not as great a likelihood, but if you did, if you had an opportunity to do that and save some of your sanity, and get the kids out of the house, good for you. We will get to deduct some of it. So increased eligible expenses. So it went from 3,000 up to 8,000 for one dependent, 16,000 for more than one. So if you've got 3 kids, we're not going to jump up to 24,000. 16,000 is the most of expenses that we can write, but it's definitely an increase from the previous year. And the phase out went from 15,000. So generally, we didn't really see this at all, up to 125. So if I'm reading that correctly, that means we can make up to $125,000 before it starts to phase out. When before, as soon as you went over 15, it was on its way, going away. So a lot of the times you had dependent care, you paid for it, you had expenses, but it didn't actually give you a credit at all. This jumping up, we might actually see this more. If, like I said, if you were able to get your kid into school. So yeah, complicated phase out, 1% of each 2,000 over 125,000. So if you want to do the math, you can on your own time. I think I've got like 10 minutes left and we've got way too many slides. So we're going to keep going. So yeah, if you have questions, we're here for you. Ask us. We'll work our way through it. You have to have kids anyways for this to work. So I want to continue moving forward. Other considerations with kids at home. You know, it may or may not be. You know, it could be, it could not be. Cobra, I'll get back to that because Chris has to go and he hasn't talked at all yet. So let's hear from him. There we go. The dude. Here we go.
All right, show me screen. What are you guys looking at?
Unemployment exclusion. You're set.
Yay. Okay, so raise your hand if you're unemployed this last year or claimed any income from unemployment compensation. Great. Okay, lots of you out there. There is an exclusion of the first $10,200 of unemployment compensation from taxation. That is an exclusion per person. So in a joint tax return where you had two people who are unemployed, their first 10.2 of each of their unemployments could be excluded from taxation. The break, however, was that it applied per household. So if you file a joint tax return, you could do this with modified AGI up to $150,000. If you're a single person, that same $150,000 applied. So not as advantageous as it could have been if they had doubled that, but they didn't. The exclusion may increase other benefits limited by AGI because when that 10.2 comes off of AGI, other things kick in, like qualification for stimulus payments, like some of the other exclusions that go at 150. If that exclusion brings you below 150, then that helps. The other really great part about this was UI, unemployment income or insurance compensation, was included or is included in MAGI. No, it's not included in MAGI. So your modified adjusted gross income is less any unemployment comp you received. If you got a total of 100, but 30 of it was from unemployment, your MAGI is really 70. And the 70 is the number. So if you're a single person and you're trying to get that $1,400 and you were at 100 and all of a sudden now you're at 70, that 70 might include or get you included for some of the other money. So interesting. The IRS worksheet originally included it in MAGI and then later it didn't. Planning pointers. Exclusion doesn't mean all unemployment is tax-free, just the first $10,200. IRS is currently advising taxpayers not to file amended returns. We held returns because we didn't want to have to go through this amendment process, but the IRS is now saying they're going to amend the return and send you the money. Again, a miracle if all that happens with all the different things they're going to calculate and all the different codependencies that taxes have. It's going to be crazy. This benefit may not be extended for 2021, even though unemployment continues into 2021 for a lot of people. So we're watching for legislation that will include this same exclusion for 2021. That's where that newsletter Conrad was talking about is so important. Read the newsletter. This could continue. Student loan forgiveness. There are a lot of programs out there that if you got a student certain types of student loans and then did certain types of activities after you graduated from college, you could get your student loan forgiven. The weird thing about this one, and we're just going to do it real quick, the weird thing about this is you had to have known this 15, 20 years ago that they were going to do this, okay, to be able to take advantage of it. So this is a very random, very spontaneous, very wow, you're a lucky person if you qualify for this. But it used to be that if you had one of those programs, did one of those things, then all of a sudden they forgave $100,000 of student loan debt you had, you got a cancellation of debt 1099 for that 100 grand. It became income. They're saying from 2021 to 2025, that income will not be income. That debt forgiveness is not going to be included in income for these 4 years. Again, 5 years, sorry. Random.
No,
Oh.
I did hear something about this.
Oh, what'd you hear?
And they were saying that they're expecting this to be a setup for the rest of some student loans being forgiven. So even though you may not have these types of student loans, they believe this is the first step towards other student loan debt forgiveness.
Okay, this is also known, Kathy, as the slippery slope.
Yeah.
Then. So once they start this, then they start something else, then they start something else, and then we're living in socialism. All hell breaks loose. It's craziness. Who knows?
So if you have student loans,
this could really be good for you. This could be a good thing. Yeah. Yes. And last on my list, EIDL grants. EIDL is about to be rewritten. We're going to get that news any day now, sometime in April. It looks like instead of 6 months of expenses, which is how they cap these loans, they're going to make them 12 months of expenses. Lender or the SBA is going to reach directly out to people with EIDL loans and offer them the opportunity to borrow more on this process. If you have one, you were supposed to start repaying 12 months after you get your money. They've now made that 24 months. So they are doing all kinds of stuff to, again, push as much money into the economy as they can. And Conrad, I'm going to shoot it back to you.
Nice. Well
so
done,
I'm
Chris. That was
going
super
to
fast.
Stop
I already took it.
sharing. Oh,
I
good.
think I did
Okay,
it.
cool.
Nice.
Yeah,
I'm
you
getting
did.
faster. Only took
Do
me
it.
the entire webinar. So yeah, Cobra benefits here. Okay, so we got a little bit to cover and then we're done. I promise. So Cobra benefits, yeah, and we're like, oh, it won't even take 60 minutes. Of course it. So there's just too much good stuff. So basically, this is what happened. You're on Cobra if you got let go from work and you wanted to keep your insurance. That's what Cobra is. You essentially get 6 months free Cobra continuation starting April 1st of 2021. What this means is that this benefit is for the employee. So this benefit is you went off of you lost your job. You wanted to keep everybody on health insurance. If if you're paying for your family or just you want to stay on health insurance. Now's a good time to have health insurance, not a good time not to have health insurance. So with this, you basically you need to make those payments, but you can request reimbursement from your previous employer. So the way that works is it's not going to happen automatically. So it's not like the stimulus checks that are just going out. You actually have to do something for this money. You must request it, and with it, then your employer can reimburse you. Why would they reimburse you, you ask? Well, there are credits available to them. So this is now the employer side of everything. The employer can go ahead and reimburse you. They'll give you the money, and then they ask for a refundable credit for their premiums that they've paid. So again, we're not exactly sure how they're going to do it. We were talking with Tara at the beginning of this and saying it's probably going to be on Form 7200. That's a good chance of how they're going to try to figure it out. But yet this is another perfect example, and I think it's a good one to end with. How everything is impacting everything. We just showed you an employee and an employer benefit. So we have to be paying attention. So with that, I'm sure there are tons of questions. We are out of time at this point.
1 minute.
We have 1 minute to cover them. So with it, like I said before, this was almost like a blitzkrieg. I feel like a lot of information all over the place. You will get all the slides, and you will get answers if you ask the right question. But
Well, and there was one question I wanted to answer, Ron. Ron, this is a vintage jacket that I got on eBay. Okay, Ron asked me where I
there's
got
time
my.
for that.
Yeah.
Okay.
Okay. Yeah. Well,
Yeah.
that was the only question that I saw that I wanted to answer. But with that, let me hand it right back to you, Conrad, for the wrap up.
Yeah. So I don't.